Welcome to Asset TV. I'm Jillian Kemmer. Emerging markets have sparkled compared to their developed counterparts. Is this set to continue? Today, I am joined by Mirae Asset Global Investments' Malcolm Dorson, an EM-focused portfolio manager who will give us a primer on the opportunity set. Malcolm, thanks for joining us again.
Thanks for having me.
Of course. Why is this a good time to be invested in emerging markets, and what is your view for the asset class moving forward?
Well, I think it's always a good time to be invested in emerging markets, and that emerging market equities should be a part of anyone's portfolio. Let's starting with the structural reasons. Emerging markets represent 50% of global GDP, 80% of global GDP growth, but only 10% of global equity market cap. So you're coming from a low base. Emerging markets are transforming as we speak from commodity-driven, manufacturing-driven economies to more consumption-driven economies. In the past 10 years, we had a really tough emerging market down cycle, which adds to the lower base that we're coming from more cyclically in addition to the structural story. And that leads us to really significantly higher GDP growth rates versus developed market countries. So you're looking at GDP growth rates at 5–6% versus what you would be excited about in developed markets at 2–3%. And that flows down directly to the bottom line at a lot of the companies that we're looking at within these economies. So you're seeing superior growth rates for these companies, and then you might take a step back and say, okay, but is that baked into valuations? And it's not. Emerging markets have always traded at a discount to developed market peers because of the associated risk. But that's on average been about 20–25% discounts. And right now, EM equities are trading at roughly a little over 30% discounts to developed market peers, which is the highest spread we've seen in the past 10 years. And that doesn't really make sense to me when you take a look at the market and say, all right, well, in the past 10 years, we've seen a convergence in corporate governance standards. We've seen a convergence in accounting standards. A lot of these companies have listed on the New York Stock Exchange, have listed ADRs. There's just a general larger acceptance of globalization. We know what's going on in all of these countries. There have been significant economic reform. There's been significant political reform. In essence, these economies and the asset class in general has been de-risked. So the valuation gap doesn't really make much sense to me, considering everything that we just mentioned, in addition to this significantly higher growth rates that we're seeing. And at the same time, emerging market companies are bringing returns higher than developed market peers. So all in all, from both the structural and bottom-up opportunity, I think emerging markets are set in a very strong position right now.
Now, historically, emerging markets haven't been immune to the movements of the Federal Reserve. As the U.S. goes on a rate hike trajectory, are you concerned?
I'm not, but yes, I totally acknowledge that in the past there has been that association with EM weakness in a hawkish environment. And if anything, I think that leads to a knee-jerk reaction now that creates an opportunity for us to build bigger positions in higher conviction names and higher conviction countries as well. So in the past, emerging markets had been a little over-levered and levered themselves in dollar debt, which created exposure to these situations in hawkish environments. But as we're coming out of a really difficult down cycle in emerging markets, countries have delevered, people have taken the necessary medicine, the companies within these countries have really gotten leaner, cut their costs, refinanced their balance sheets into local debt, away from dollar debt. And from a big picture perspective, on average, emerging market countries are actually working at current account surpluses versus current account deficits, as we've seen in the past. And more importantly, I think this semi-hawkish environment that we're seeing in the United States now, that signals an end to the global financial crisis. It signals a normalization of monetary policy. So it means we're working with a strong developed market world. And in a strong developed market world, if you're looking for alpha, if you're looking for extra growth, the best place to find that should be in emerging market equities, in my opinion.
Now let's dive into the opportunity set. What are some of the trends or themes in emerging markets that you're investing in right now?
We're always excited about consumption, and we say consumption from a wide perspective. So it's not just consumer discretionary names. We're looking at staples. We're looking at opportunities in banking. We're looking at opportunities in food services. I think right now about 35% of global consumption comes from emerging markets. That number is supposed to rise to 50% by 2025. It's a catch-up story. It's a catch-up in financial inclusion, digital banking. It's the way people are eating, dining out. It's the way people are traveling. That really creates, as people are moving into higher income classes, they have more discretionary income. As economies are improving and we're seeing inflation rates come down, that adds some more discretionary income. People are spending more, and these economies are moving moving away from dependence on commodities and manufacturing into more consumption-oriented activities. Another area that we're excited about is the global mobility picture in terms of mobile phone use and data consumption. That is has sort of two hats. In one perspective, it's translating different specific sectors in terms of communication, digital banking, ordering food, traveling, I mean, across the board, e-commerce, obviously. And then from another perspective, from a big picture country perspective as well, with the access to more communication, people seeing what their neighbors are doing. Access to power, access to information isn't just coming from the political centers, from the economic centers anymore. People are well informed in the outskirts, in more remote parts of different countries. So they're more empowered to see what's going on, to not stand for corruption anymore, to actually have more information about political candidates and vote for people that have their best interests at hand. That's leading to more economic reform, political reform, and on a whole, de-risking the asset class, which is great for what we do.
So when it comes to emerging market investing, many investors associate the asset class with China and India, but what are your thoughts on some of the smaller emerging economies?
The smaller economies are the areas where we see probably some of the most opportunities. We are invested in Argentina. We're excited about opportunities in Romania. And one country where I'm especially excited about is Egypt. Egypt faced a difficult period the past few years. They were facing significant twin deficits. They had to approach the IMF for a bailout, kind of a classic emerging market story. And with that, they committed to the IMF's playbook. They floated their currency, and with the floating currency, inflation picked up. So inflation spiked to about 30%. Central bank acted independently and prudently, which we thought and saw as very important and responsible. So interest rates rose 900 basis points. That sort of choked off growth in combination with the government committing to austerity, so cutting subsidies and raising taxes. But at the same time, that was all the necessary medicine Egypt had to take. So that's behind us. And during that period, fixed income investors saw the natural carry trade. So you see an economy where they're acting responsibly. It looks like you're going to get paid back. They're fixing their fiscal problems, and you have an opportunity to receive 20% on Egyptian treasuries. So money started coming in from the fixed income side. At the same time, Egypt was fortuitous in the natural gas finds that they found with the Zohr fields, and at the same time, El-Sisi was really picked up his pressure on security, which is starting to bring tourism back. So with the combination of those three facets, you're seeing lots of FDI come back into the country. Helping take pressure off the currency, actually strengthening the currency, which is bringing inflation down. And with inflation coming down, the central bank now has the opportunity to start cutting rates. Just last month, they pivoted from their hawkish stance to a monetary easing cycle, cutting rates 100 basis points. And we think that they've got 500, 600 more basis points to go. So that should spur growth for the next 1-2 years, coming from a very low base. And there are tons of opportunities within the economy that we're excited about.
Now, obviously, you're an active manager. Why do you think it's so beneficial to employ active management when investing in emerging markets?
I have to say it, but I always think active management it definitely has its advantages, but especially in emerging markets. I think that there's a big differential in emerging markets for a few reasons. One, if you're investing through passive strategies in emerging markets, you're looking at strategies built off of indices and benchmarks, and the benchmarks are backwards looking. So as one of the bigger themes in emerging markets is that they're growing, they're evolving, they're moving away from older economies to new economies. So the new companies coming into emerging markets are the ones that are more efficient, they're higher return, they're professional management teams, they're not state-owned enterprises, they're generally not older family businesses. So these are the companies you want exposure to. They're the ones who have the opportunity to take advantage of the fantastic demographics that these countries have. And the indices are backwards looking. So it takes 12 to 18 months to get these names into the benchmarks. So you're missing out on those opportunities. Another reason is that the benchmarks are generally based off of the larger liquid names, which traditionally are state-owned enterprises, SOEs, which are the national champions of these countries, whose management teams and board of directors are often made up of political appointees, whose really they're focused on keeping unemployment low and wages high and their names out of the newspaper to get themselves reelected, and they don't have an alignment of interest with minority shareholders in terms of cost cutting and driving higher returns and efficiencies for the company. And last, emerging markets it's an easy term to say, but it's very, very broad. So what's going on in Mexico doesn't have much to do with what's going on in China versus what's going on in Poland. So different political systems, different economies, different trends, different structural shifts. I think it's in everyone's best interest to have a manager who understands what's going on and knows all of these differences to understand and pick their battles for them.
And lastly, Malcolm, how does Mirae Asset differentiate itself from other emerging market managers?
Well, Mirae grew up in emerging markets. We're a Seoul-based asset manager. We have offices all around the world, in mainland China and Hong Kong, clearly in Korea, in Brazil, in India, in Colombia. We're all over the world. Our investment team is made up of 10 investment professionals, and there are 10 distinct different languages spoken on the team as well. So we're reading local newspapers, interacting with local media. We use or know local products. We believe in and use the products that we're invested in. We know the management teams, we're visiting the management teams, we're actually seeing the factories, kicking the tires, and I think that provides a really big competitive advantage.
Well, Malcolm, thank you so much for taking the time to share not only your outlook for emerging markets, but what makes you different in the space.
Thank you.
And thank you for tuning in. From our studios in New York, I'm Jillian Kemmerer, and this is Asset TV.